Yeah, for the first time in a while, real estate has a bull market uh, tailwind. Basically, real estate is highly interest rate sensitive, and with the rise from interest rates going from 0 to 5%, 5.5%, that really hurt real estate prices, especially institutional real estate prices that price off yield. Now we're talking about rates falling by potentially 50%, from 5.5 to 3%. And that could have a huge impact on real estate prices.
And when you're talking specifically about those real estate prices, obviously there's commercial and then residential real estate, but you've talked about how apartments are likely to see a rally, but not necessarily as clear when it comes to single family housing. Kind of unpack that for us.
Yeah. Well, so single family housing is priced by supply and demand. And so what surprised, I think, a lot of bears in the last couple of years is that high interest rates didn't lower single family housing prices. Actually, housing prices stayed healthy. And that's because most people have long-term fixed rate mortgages. The average mortgage is below 5%. I think 75% of people have a mortgage below 5%. And so the reality is that high interest rates really didn't impact the housing market like people expected. And home sellers didn't want to bring their house to market when interest rates were so high. So what ended up happening is supply of housing from existing homeowners was absolutely depressed. It's the lowest almost in history. And that low supply of housing kept prices up because prices are determined by where supply meets demand. So now, as interest rates start to fall, on one hand, that's good. It'll make housing more affordable. On the other hand, it may bring more houses to market.
That's kind
And
of
if more houses come to market, that could actually cause prices to actually stay dampened despite falling interest rates.
right. And that's kind of where I wanted to go, Ben. I'm looking at the Mortgage Bankers Association 30-year fixed. It peaked kind of back in late 23 at about 7.8, 7.9%. We're now down to 6.5. Where do you think mortgage rates need to go? Is there like a clearing level, you think, where the marginal seller would come back into the market and we'd get some more activity in the real estate, residential real estate?
Yeah, but my view is that mortgages will end up in the mid fives as most likely. But unfortunately, if you look at the last decade, the average mortgages were in the threes. And so for a house to get as affordable as it was in the 2010s, you really need not just rates to fall, but you need wages to increase. And that's going to take a long time. And so affordability is going to remain a challenge, I think, through the rest of this decade as we make progress on wages and bring rates down, but not to where they were last decade.
And when it comes to obviously higher rates and how that has slowed new construction, especially when it comes to apartments, what do you think that could mean for when we have the direction and the path for cuts potentially coming soon here, but not necessarily what it seems like, not at an aggressive pace, but even if it is more gradual, do you think that could ease some of the slowing that we did see with new construction for apartments?
Right. So just to recap, what happened was the low rates in 2021, 2020 caused a spike in new construction, especially in apartments. It's an all-time high. And that new supply started in 2021 and is delivering now. And so right now we're at all-time high. But if you look at starts or new construction, we finance and build a lot of housing. We probably are financing new construction in the thousands of units. And you're seeing that it's very difficult to start a new apartment project. A lender is very reluctant to lend. They're lending at low proceeds, so maybe 55% of the cost of the project, and at maybe a 7% interest rate, maybe even higher. So it's very hard to make it pencil, and so new construction is falling off a cliff. And as a result, by late next year, there'll be some of the lowest new supply in probably modern history. So we're going to go from an oversupplied to undersupplied market, and as a result, I think that we'll see rents continue to grow, rent prices continue to grow because of the falling supply of new apartments.
Hey, Ben, let's switch gears a little bit. On the commercial side, I think the most concern for, most investors is on the office market. Where are we in terms of kind of flushing out and trying to find a bottom there? I don't see a lot of transactions that would help me to get a sense that maybe this market's bottoming.
No, no. I mean, there's a real fundamental change. I mean, the market has lost somewhere between 30 to 50% demand for office as a result of work from home. So from pre-pandemic to now, office occupancy is probably going to fall 30 to 50%. That will have a consequence to office rents and office prices, and that process is going to take at least a half a decade, another 5 years, I think, of decline, repricing, sort of compounding or vicious cycle dynamics. And so that is, I think, not only is it obviously bad for the $3 trillion of office, which probably will lose at least $1 trillion of value, maybe $1.5 trillion of value, but also for downtowns across the country, downtown DC, downtown San Francisco. I think the city budgets and the state of those streetscapes are going to see a lot of challenges that I think no one has like good solutions in the midterm. I mean, probably going to take half a decade to really find the bottom and really figure out how to rebuild those downtowns.
One question I have is when it comes to work from home. I know Paul's very passionate about this. We actually have a work shift column here at Bloomberg. And so there was an article earlier this summer where they talked about empty offices risk wiping out about $250 billion in commercial property value. So that U.S. office vacancy rate is forecast to hit a peak of 24% by 2026. If you looked at where it was sitting, basically in the first quarter of this year, it was around 19.8%, Paul. So I kind of wanted to pick your brain when it comes to what you're looking at this bin and that kind of dynamic from the work from home sort of aspect in your sort of purview in what you do.
Yeah, so Fundrise is a technology company and also an investment company, and so we understand a lot about both how technology affects the markets, and also we have 2 million users, 2 million customers, and so we have a really good sense of how people behave across the United States. And so the reality is that work from home is not only permanent, but I think we're still actually at the beginning of a cycle of technology affecting office. I mean, we saw this happen with e-commerce. 1999, e-commerce was only 1% of all commerce. Now it's 16% of all commerce. And work from home today is, approximately 25%. And I think it'll grow because we'll see more technological progress. AI will have huge impacts on the efficacy of working from home, virtual reality, driverless cars. And so I think that the extrapolations into the future are underestimating the impact of technology.